Think big, trade smart. This video is presented by Meitou Investing. Hello guys, welcome back to another Meitou video. The thing of the recent market right now is like no different than a regular roller coaster experience, where we're basically going down and up like crazy. And I know, this may feel fresh for some of you who just began stock trading, but the crazy thing is that this time is like no others that even for people who are experienced, not many people knows what to do. Based on the market correction in the past few weeks, for today's video, I want to share some of my personal experience on the common mistakes that people make when a correction hits the markets. The first common mistake that investors fall into during a stock market correction is that they often make investment decisions based on their stock prices. Recently, the Nasdaq has a sharp pullback, and I have received some messages from people saying that many of their stocks are losing more than 10%. Then they asked me if they should sell it, and then there are some other people who said that they have accidentally bought at the high point, and then they asked me, is it a good time at the stock callback to reduce my average cost? All of these questions are related to typical investment decisions based on their views on the prices. Decisions based on stock price are the most common mistake that people make. And while it may not be too bad in a bull market, it can be extremely costly during a correction. And as people have more losses during the big crash, they're more likely to make investment decisions based on the stock price. You probably have times when you see these red candles and numbers on whatever the apps or websites that you check the price, and then you're staring at them while asking yourself inside, oh my god, why didn't I sell them yesterday? This mentality of making investment decisions based on the stock price can greatly affect your mood and make you more likely to make irrational investment decisions. In terms of behavioral finance, the act of making decisions based on stock price can be explained by the anchoring effect. The anchoring effect says that when people are making decisions, they're often distracted by information from the past. This information from the past is called an anchor point, which we're often unconsciously making our decisions based on this anchor points. For example, this anchor point could be your purchase price or the all-time high on the record. So how do you know if you are influenced by this anchor point? Ask yourself these two questions. Have you or do you think you would buy or sell based on how much money you have lost? Or are you hesitant to invest because the stock is at an all-time high? These are all classic misconceptions of making investment decisions based on stock price, which are interfere with the anchoring effect. To judge whether it's worth investing in a stock, the correct investing is based on the impact of new information to the stock price, not the past prices such as the purchase price or the all-time high. What you should consider when investing is whether the stock will pay you back in the future, not how much money you have lost in the past. So in order to systematically address the problem of making investment decisions based on stock prices during a correction, the first step we should take is to investigate the causes of the decline. The reasons can be divided into two categories. I call them the substantial decline and the panic decline. There are different types of strategy to deal with different types of falls. But how do you tell what kind of drop is it? Well, here I got a small tip for you. You can tell it based on the impact of the decline to the future cash flow of the company you have invested in. If there is an impact, then that is a substantial decline. Otherwise, it's a panic selling. So what should we do next after we have identified the cause? Well, first, in the big picture, you need to consciously eliminate all the anchor points mentioned above and make your investment decisions based solely on whether the stock will pay you back in the future. Second, if there is a substantial decline, then the stock price will not go up because of your loss, but the company's future valuation will go down qualitatively, and you can't expect your stock's price to come back anytime soon. If this happens to stocks you own, you normally have to do something about it. In the Nasdaq correction, for example, it's due to a rise in the long-term interest rates. This is a substantial decline because the long-term interest rates are unlikely to return anytime soon and may even rise further. Then doing a bit of asset allocation would be a smart move at this time. If you do have some cash, it's better not to jump into the bottom or a drop like this, because even if the markets will eventually rebound in the short term, it will take time to digest the impact of the substantial decline before it gets back to the top. Third, if it's a panic decline, then what you should do is you must avoid panic selling, especially for stocks that you plan to hold them for a long time. If you're watching the market while they have some cash during the panic fall, it's often a good buying opportunity. And in this situation, my favorite thing to do is to sell put options on the stock, because that's when volatility increases and the options becomes more expensive. Such a move will not only benefit from a short-term return to the stock markets, but also makes money from the excessive investor panic. And of course, sometimes the stock market's decline is not by a single factor, but often a combination of material factors and panic factors. This is where investors needed to be more subjective. However, the above three coping methods are also applicable and can well solve the problem of making investment decisions based on the stock price during a market correction. The second common mistake that I often see people make during a correction is that when it comes to dealing with risk, people often choose to wait rather than act. There is a very interesting phenomenon in the stock trading, is that people embrace risk. And when people do so, they tend to favor fast-making and fearless decisions. And when they face situations where control of risk is needed, they hesitate, and then they choose to wait. For example, during a market correction, we often see people desperate to find the bottom, and this is a very risky decision, and they would buy more and more to embrace more risk when the decline is bigger. But if you ask them to cut down their tech stocks going on the downside and diversify their holdings into traditional stocks, they tend to balk. I bet you could recall the same thing happens when there's a bull market, which people are more willingly to do risky investments, such as by taking a full position in a large bull stock or buying a call option on one stock. Instead, for the diversification of assets or the protection of hedges of control risk, they then chooses to wait. In fact, this mentality also confirms a classic concept in behavioral finance, loss aversion bias. It means the pain of losing is often far greater than the pleasure of making money. As a result, we often make the wrong investment decisions even though we know what the right decision is, because we can't afford to lose money when we realize we're wrong. For example, just right before the correction, many investors may be envy of others who profited so much from the high-yield tech companies, or they just didn't want to give up their already accumulated gains, while they already know that the valuation of the high-growth tech stocks has already reached a peak. They still choose to increase their tech holdings. Yeah, these are people basically who don't want to miss every last penny they could earn from a bull market. In fact, over the past few days, I have been cautioning people about a shift in asset allocation, moving from high-growth technology companies into more traditional value stocks. I'm sure many of you would have agreed with me, but I bet most of you have probably chosen to wait. But honestly, no one's perfect. I'm still introspecting myself that I didn't do a good job in times to position adjustments. This is because loss aversion bias, the loss of potential profits, prevents me from doing what I think is right. This is especially true during a pullback. During the past weeks, I have more than once reminded you to cut some confidence in tech stocks and move your money to traditional value stocks, and don't forget to always hedge your holdings. If I have said this before, many people may not believe me, but at today's point, the market trend is so clear that I believe most of us can realize what the right investment move is. However, many people still cannot bear the immediate losses or hope the rebound may come at any time, and choose to continue to wait, resulting in more irreversible losses. When I realize I'm stuck with a loss bias during a correction, my approach is to tell myself it's never too late to do the right thing. Often when we choose to wait, it's not like we don't know what the right thing is, but we often think, oh, I might gain or lose this much if I'm doing this, but what if there's a rebound? In fact, in investment, it's not terrible to make a wrong decision, but it's terrible that you know you haven't made a mistake and you are still hoping for some kind of luck. But if you can minimize the impact of losses on you, simply by the logic behind the investment moves, you may suffer some losses due to the bad luck at this time, but in the long run, you will earn much more. The last common mistake that investors tend to fall into during a correction is that they are unable to get out of a bull market mentality in time. In a bull market, it's easy to make money no matter how you do it. Whether you chase the high or the low, the results may not be too bad. And many people therefore then figure out a system of stock trading for themselves. And this is the most dangerous thing about a bull market. It can often transform iron into gold. But when it comes to a pullback, the so-called bull market system now becomes the problem. To me, the biggest difference between a bull and the big correction period is that the bull allows you to spread out your bets in so many stocks. And while in a correction period, you should always keep a high fault tolerance for yourself. And I think keeping a fault tolerance is the hardest mentality to maintain in stock trading. So what does that mean by having more capacity of fault tolerance during a stock trading? Well, to me, it means treating every single investment move as a possible mistake. In other words, if you do something wrong, you have something to back you up. Let's take a counterexample. So, many people like to buy stocks at a decline to buy at the bottom, and if the decline extends, people tend to buy more. However, if the stock market continues to fall, they're more likely to suffer huge losses. Another great example is that when stock falls sharply in a single day, and some people start to panic and then they will sell their holdings, which would cause them to miss the gains they could make on a rebound. These are moves that are typical examples that are not giving yourself a second option. Well, since we can't judge the size and the timing of a correction, then is it better doing nothing with the stock market crash? Not really, to be honest. Many investors often wouldn't be able to react to the above situations correctly, and they normally will overcorrect their mistakes. In fact, it's not a big no to do some risky investments or buy at the bottom. But it's kind of the reverse. Stock market pullbacks tend to present more investment opportunities than ever before, and they are very attractive. If you can catch any of these opportunities, luckily you may end up with a huge profits, but otherwise you lose more. In this case, it's very important to have a backup plan. For example, let's say that during the correction you think Apple stock has fallen too far, that it can be undervalued, and that's a very good buying opportunity. Then you are either someone thinking about Apple to go up in the short term, or you are going to buy it at the bottom. In this case, instead of buying a call, buying Apple stocks will give you more rooms for false tolerance. Because if the Apple stock continues to fall, call option will not only fall more, it will also lose time value. But if you hold shares, although the stock price might continue to decline in the short term, but when the stock prices rise back, then any of your losses in the short term will be covered up without any additional losses. And if you think of a further step, instead of buying shares, if you do sell naked put on Apple to go up, then it will give you more capacity of false tolerance. Because a sell put can also be achieved by rollover or taking over the stock. Even if the stock price continues to fall, as long as it comes back, you will still break even. Also, if there's a sell-off, the sell puts can also obtain more premiums to compensate for more potential losses. Of course, a sell put can be added to an upward trend, such as a deep out of the money put to prevent further decline, or a sell put followed by a sell call to hedge the downside risk. Because these option strategies are very complicated to explain, I won't go into details here for the benefits of the majority of audience. But the ideas are here for you. If you want to do some risky investments or waiting for the bottom, you must expect that it may be a result of a loss and you should have a backup for it. Otherwise, you're exposing yourself to an irreversible risk. To wrap up today's video, if the above methods of options trades are too complicated, there's a simpler and more practical way to give you more capacity for false tolerance, and that is diversification. In a bull market, our holdings inevitably gravitates towards two stocks that are going up. But in a pullback, however, diversification is essential. In this case, I will also sell some stocks that I have low confidence in and high volatility. Then I will move my money into traditional industries that are less risky and more stable. Especially in the current asset allocation shifts under the general trend, this approach is more effective. Although it might give me less gains when the stock rebounds, but it also helps me to sleep better at night in the face of a potential further decline. If you like my videos, please click the subscribe button Your supports are much appreciated.